The Asset Game: How the Wealthy Build Income That Works Without Them. Published by Timeless Audiobook. Introduction. Wealth is not built by effort alone, it is built by ownership. The difference between those who stay busy all their lives and those who grow financially free is not intelligence, luck, or background. It is understanding the asset game. Money earned from labor stops when labor stops. Income built from assets continues, whether you are present or not. That is the dividing line. The wealthy learn early that time is limited, but assets can multiply. They stop asking, "How can I earn more?" and begin asking, "How can I build something that earns for me?" This audiobook is not about chasing quick money. It is not about hype, trends, or risky speculation. It is about learning the structure behind lasting wealth. It is about shifting from being a worker in the system to becoming a builder of systems. The asset game rewards patience, clarity, discipline, and strategic thinking. It favors those who understand leverage, control, and cash flow. It rewards those who think in decades instead of days. In this audiobook, we will break down the rules of the asset game step by step. We will explore how income traps keep capable people stuck. We will learn how to recognize true assets, how to build income engines, how to stack opportunities, how to scale wisely, and how to protect what you create. You will begin to see money differently, not as something to spend, but as something to position. By the end, your perspective will change. You will no longer measure success by hours worked, but by assets owned and systems built. The game has always been there. Now it is time to learn how to play it. Let's begin. Chapter 1. Escape the Income Trap. A steady paycheck feels safe. It feels responsible. It feels like progress. And in the beginning, it is. Earning money through your skills, your time, your effort. That is honorable. But safety can quietly become a cage. Comfort can slowly become control. And control, when it belongs to someone else, is never real security. The income trap is simple. You work, you earn, you spend, you repeat. As long as you show up, money flows in. The moment you stop, it stops. Illness, layoffs, burnout, aging, any interruption breaks the chain. Your income depends on your presence. Your life depends on your energy. And energy, no matter how strong you are, has limits. High income does not solve this problem. In fact, it can hide it. A larger paycheck often creates larger expenses, a bigger house, a better car, more commitments, more obligations. The lifestyle expands, and with it, the pressure to keep earning. You are no longer just working for income, you are working to maintain the structure you built around that income. The trap tightens, even as the numbers grow. Think about it carefully. If your income requires you to be there every day, trading hours for currency, then you are still in the trade. You may be well paid, you may be respected, but you are still exchanging time for money. And time is the one asset that never replenishes. Escaping the income trap does not mean quitting your job tomorrow. It means shifting how you think about income. Instead of asking, "How can I earn more this month?" you begin asking, "How can I build something that earns whether I show up or not?" That question changes everything. It moves you from earner to builder, from participant to strategist. The wealthy do not depend on a single stream of active income. They use their earnings to acquire or build assets, things that generate cash flow, businesses, real estate, investments, intellectual property, systems. Each asset becomes a small worker. Each one produces value repeatedly. Over time, those small workers replace the need for constant effort. Here is the key. Freedom comes from ownership, not activity. You can be busy every day and still be financially fragile. Or you can be strategic, building slowly and grow stronger each year. The goal is not to work less immediately. The goal is to work with purpose, to use your current income as fuel, to convert earned money into owned assets. At first, progress feels slow. You build one asset. It produces a little. You reinvest. You build another. Momentum is quiet in the beginning, but momentum compounds. One stream becomes two, two become four. Eventually, income begins arriving without your direct involvement. That is when the trap loosens. That is when dependence turns into leverage. Security built on employment alone is temporary. Security built on assets is structural. One relies on permission, the other relies on ownership. And ownership changes your posture. You think differently. You negotiate differently. You make decisions from strength, not fear. Escaping the income trap is not about rejecting work. It is about elevating it. Work becomes the foundation, not the destination. Your job becomes the investor in your future, not the master of your time. You stop seeing income as something to consume and start seeing it as something to deploy. This is the first shift in the asset game. Recognize the trap. Respect the effort it took to get here. And then decide quietly, firmly, that your income will no longer depend only on your presence. Because the moment income continues without you, the game begins to change. Chapter 2. Learn the rules before you make a move. Every game has rules. Some are written, some are unwritten, some are obvious, others are invisible to the inexperienced eye. The asset game is no different. Many people rush into investing, business, or opportunities without understanding the structure beneath them. They make moves before they understand the board, and when you don't know the rules, even a good opportunity can become a costly mistake. Wealth is not random. It follows patterns, it follows principles. Cash flow behaves in predictable ways. Taxes operate under defined systems. Markets move in cycles. Risk and reward are connected. None of this is mysterious, yet it feels mysterious to those who never take the time to study it. The wealthy rarely gamble blindly. They observe, they analyze, they understand the mechanics before they commit capital. One of the first rules is this: cash flow matters more than appearances. An asset that produces consistent income is fundamentally different from something that simply rises in value on paper. Appreciation can be powerful, but cash flow creates stability. Cash flow pays expenses. Cash flow reduces pressure. Cash flow gives you options. Without it, you are speculating on the future. With it, you are strengthening the present. Another rule is leverage. Leverage is often misunderstood. It is not reckless borrowing. It is not unnecessary risk. At its core, leverage means using resources beyond your own to expand results. That could be money, but it could also be people, technology, systems, or partnerships. The wealthy understand when leverage accelerates growth and when it increases danger. They respect it. They calculate it. They do not let emotion guide it. Risk itself is another misunderstood rule. Risk is not something to fear blindly. It is something to measure. Every investment carries uncertainty. The question is not, is there risk? The question is the risk controlled, calculated, and justified by the potential return? Those who win consistently do not avoid risk entirely. They manage it. They prepare for downside scenarios. They ask what could go wrong before celebrating what could go right. Taxes form another quiet rule of the game. Income from labor is often taxed differently from income generated by assets. Ownership provides structural advantages that employees rarely experience. This is not accidental. The system encourages investment and production. Understanding this difference changes your strategy. You begin to see why the wealthy prioritize ownership. It is not only about income, it is about efficiency. Then there is the rule of patience. Impatience is expensive. Markets reward discipline over time. Compounding needs consistency. Assets need time to mature. Quick gains are attractive, but sustainable growth builds quietly. The wealthy do not chase every trend. They study long-term value. They understand that preserving capital is just as important as growing it. Another critical rule: clarity beats excitement. When opportunity appears, emotion rises. Enthusiasm can cloud judgment. A disciplined investor steps back. They ask structured questions. Does this produce cash flow? What are the costs? What are the worst-case scenarios? Who controls the asset? What is the exit plan? Decisions made in calm analysis outperform decisions made in excitement. Control is also part of the rule book. Ownership does not always mean total control, but influence matters. Being positioned on the right side of a deal changes outcomes. Equity, voting rights, contractual protections, these details matter. The wealthy pay attention to structure. They know that structure determines outcome more than optimism does. Perhaps the most important rule is education. The asset game rewards those who continually increase their understanding. Financial literacy is not optional. Reading balance sheets, understanding return on investment, calculating cash-on-cash returns, evaluating debt ratios. These skills are not reserved for experts. They are learnable, and once learned, they change how you see every opportunity. Rushing into the game without understanding these rules is like entering a chess match without knowing how the pieces move. You might win by chance once or twice, but consistency requires comprehension. Study creates confidence. Knowledge reduces emotional reactions. Preparation turns fear into calculation. Before you buy, study. Before you invest, analyze. Before you expand, understand. Every disciplined move compounds over time. The wealthy appear bold because their boldness is built on preparation. They seem confident because they respect the rules. Learning the rules does not slow you down. It strengthens you. It positions you. It ensures that when you do make a move, it is intentional, calculated, and aligned with long-term freedom. In the asset game, the player who understands the board always outlasts the one who moves impulsively. And in this game, longevity is power. Chapter 3. Buy cash flow, not status. Status is loud, cash flow is quiet. Status shines in public. Cash flow works in private. And in the asset game, what works in private is what builds freedom. It is easy to confuse the appearance of wealth with actual wealth. A luxury car in the driveway, a large house in a prestigious neighborhood, designer brands, exclusive memberships. All of it signals success. All of it draws attention. But attention is not income. Applause is not ownership. And image, no matter how polished, does not pay your bills. The wealthy understand something subtle but powerful. Assets first, lifestyle later. They focus on acquiring income-producing structures before expanding personal consumption. They buy things that pay them. They invest in vehicles that generate returns. They look for recurring cash flow, not recurring admiration. The danger of status spending is not that it feels good. It does feel good. The danger is that it locks you into dependency. Every upgrade increases fixed expenses. Every visible symbol of success often requires invisible effort to maintain. The car payment, the insurance, the property taxes, the maintenance. What looks impressive can quietly demand constant labor. Instead of building freedom, it builds pressure. Cash flow, on the other hand, reduces pressure. When an asset generates income consistently, it supports your life rather than drains it. Rental income, dividends, profits from a structured business, royalties from intellectual property. These streams may not attract immediate attention, but they build resilience. They give you breathing room. They provide options. Think about the difference. A liability takes from you each month. An asset gives to you each month. One increases your dependency. The other increases your independence. And the distinction is not about what something is called. It is about what it does. Does it put money in your pocket consistently? Or does it require money from your pocket consistently? This does not mean you must reject comfort or enjoyment. It means you must sequence it properly. The disciplined builder delays visible upgrades until invisible foundations are strong. The house you want becomes sustainable when assets support it. The lifestyle you desire becomes stable when income arrives without your direct effort. Another subtle trap lies in social comparison. It is easy to look at others and feel behind. It is easy to see someone's visible success and assume they are financially secure. But appearances reveal very little about structure. A person may display wealth while carrying heavy debt. Another may live modestly while quietly building a portfolio of assets. The second person is playing the asset game. The first may simply be playing the approval game. Approval fades, markets fluctuate, trends change, cash flow, when built on solid fundamentals, continues. That continuity creates confidence. When income arrives regardless of external opinions, you no longer need validation through spending. You no longer need to prove anything. The discipline to buy cash flow instead of status requires maturity. It requires clarity about long-term goals. Every dollar spent on temporary image is a dollar that could have been deployed into a productive asset. Over time, those small decisions compound. One choice seems minor. Repeated consistently, it shapes your trajectory. Consider the power of redirection. Instead of upgrading a car prematurely, you invest in an income-producing opportunity. That asset generates returns. Those returns are reinvested. Eventually the asset pays for the car entirely. Now the purchase is supported by production rather than effort. The same object feels different when it is funded by assets rather than by labor. The wealthy do not avoid enjoyment. They simply ensure enjoyment is funded by systems. They understand that status purchased without structure is fragile. Cash flow purchased with discipline is durable. Durable income creates real confidence. Real confidence reduces the need for external display. The asset game rewards those who think beyond the surface. Before every purchase, ask a simple question: will this generate income, or will it require income? The answer guides your strategy. It shapes your future. It determines whether you are strengthening your position or weakening it. Choose income over image. Choose structure over display. Choose assets that pay you quietly, repeatedly, consistently. In time, the freedom you build will speak louder than any symbol ever could. Chapter 4. Position yourself on the right side of the deal. Every transaction has two sides. Every opportunity has a structure. And in the asset game, where you stand in that structure determines whether you gain power or give it away. Wealth is rarely accidental. It is often the result of deliberate positioning. The wealthy do not simply participate in deals. They position themselves on the side that benefits most from the outcome. Consider this carefully. In any business exchange, someone provides labor, someone provides capital, someone provides ownership, and someone carries risk. These roles are not equal. The person who understands how the deal is structured often benefits more than the person who works the hardest inside it. Effort matters, but structure multiplies effort. Position determines leverage. When you are only trading time for money, you are positioned as a participant, not an owner. You contribute energy and receive compensation. That is respectable, but it limits upside. Ownership, equity, and contractual control change the equation. They allow you to benefit from growth, not just from activity. When revenue increases, owners benefit disproportionately. When value rises, equity holders gain. When systems expand, those positioned correctly participate in the upside without increasing their hours. This is why understanding equity is essential. Equity is not just a financial term. It is a position. It represents a share in the outcome. Instead of being paid once for your effort, you hold a percentage of future value. That shift from payment to participation is powerful. It turns involvement into ownership. It aligns your effort with long-term reward. Positioning also requires awareness of risk. The right side of a deal is not always the side with the highest potential return. It is the side where risk and reward are balanced intelligently. Some deals promise extraordinary upside, but carry uncontrolled exposure. Others offer steady growth, with manageable risk. Disciplined builders evaluate structure before committing. They ask who controls decisions, who carries liability, Who benefits from appreciation? Who absorbs losses first? Negotiation plays a role here. Many people accept the first structure presented to them. They focus on the opportunity itself rather than the terms. Yet terms shape outcomes. A small change in structure, a percentage point of equity, a favorable repayment schedule, a clear exit clause, can significantly affect long-term results. The wealthy pay attention to details because they understand that details determine destiny. Control is another crucial element. Full ownership is powerful, but strategic control can be equally valuable. Board positions, voting rights, management authority, or partnership agreements can influence direction. Control allows you to protect your interests and guide growth. Without it, you may benefit temporarily but remain vulnerable to decisions made by others. Leverage intersects with positioning as well. Sometimes you do not need to own an entire asset to benefit from it. Strategic partnerships allow you to combine resources, skills, and capital. When structured correctly, everyone contributes value and shares in returns. When structured poorly, imbalance leads to conflict. Clear agreements, defined responsibilities, and aligned incentives protect your position. Another dimension of positioning is timing. Entering a deal early often carries more risk, but greater potential reward. Entering later may offer stability but lower upside. There is no universally correct choice. There is only the decision that fits your strategy and risk tolerance. The key is intentionality. Do not drift into opportunities. Choose them deliberately. Many people focus on what they are getting paid today. Builders focus on what they are building tomorrow. That difference shapes positioning. If you are always negotiating for higher immediate compensation, but ignoring long-term ownership, you may increase income while limiting future wealth. If you are willing to accept reasonable compensation in exchange for equity or strategic participation, you may sacrifice short-term gain for long-term growth. Positioning is not manipulation, it is awareness. It is understanding how value flows within a system and ensuring you are aligned with that flow. It requires clarity, patience, and confidence. You must know what you want before entering the deal. You must understand your contribution and its worth. The asset game rewards those who think structurally. Before agreeing to any opportunity, pause and examine the framework. Ask yourself, on which side of the deal am I standing? Am I building ownership, influence, and future upside? Or am I simply renting out my time once again? When you consistently position yourself on the side of ownership and growth, momentum builds. Each well-structured decision compounds. Over time you move from participant to stakeholder, from worker to architect. And in this game, architecture determines outcome. Chapter 5. Build your first income engine. Every structure begins with a foundation. In the asset game, your first income engine is that foundation. It does not need to be large. It does not need to be perfect. But it must be intentional. It must be designed to produce income beyond your direct hourly effort. This is the turning point, where theory becomes action. An income engine is not just a job. It is not simply a paycheck. It is a system, however small, that generates recurring value. It may begin as a side business. It may start as a small investment portfolio. It could be a digital product, a rental property, a service business with delegated tasks, or a partnership stake. The form matters less than the function. The function is simple. It produces income consistently without requiring you to trade every minute for every dollar. The first engine often feels modest. That is normal. The purpose of the first asset is not to transform your life overnight. It is to change your direction. It proves to you that income can exist without constant presence. Even a small monthly return carries psychological power. It shifts your identity. You stop seeing yourself only as an earner. You begin seeing yourself as a builder. Before building that first engine, strengthen your earning capacity. Your primary income is fuel. The stronger your skills, the more capital you can deploy. Increase your competence. Increase your value in the marketplace. Improve negotiation, communication, technical ability, whatever your field demands. Higher earnings create greater surplus. Surplus becomes investment. Investment becomes ownership. When selecting your first engine, simplicity wins. Complex structures increase risk and confusion. Choose something understandable. Study it deeply. Know how it generates revenue. Know its expenses. Know its risks. Clarity builds confidence. The goal is not speed. The goal is sustainability. Reinvestment is the heartbeat of your engine. When income begins to flow, resist the urge to consume it immediately. Redirect it. Strengthen the asset. Expand its capacity. Acquire complementary assets. Compounding begins when profits are not withdrawn prematurely. This discipline separates short bursts of success from lasting growth. Expect challenges. No engine runs flawlessly at the start. There will be adjustments, learning curves, minor failures. View them as tuition. Each correction improves efficiency. Each lesson strengthens judgment. The wealthy do not avoid setbacks. They refine systems because of them. Momentum is subtle in the early stages. The first few months may feel slow. Returns may appear small relative to effort invested. Stay steady. Engines gather power gradually. Once stabilized, they require less attention and produce more consistently. That stability frees time and mental space for building the next asset. Diversification comes later. Focus first on making one engine reliable. Depth before breadth. Master one structure before multiplying them. Once you understand how one system works, replication becomes easier. Patterns emerge. Risk becomes more measurable. Expansion becomes strategic rather than impulsive. An important shift occurs during this process. You begin evaluating opportunities differently. Instead of asking, "How much will this pay me now?" you ask, "Can this become an engine?" That question filters decisions. It redirects energy towards scalable, repeatable income rather than one-time transactions. Your first engine will likely require effort in the beginning. That is acceptable. The objective is gradual independence from your direct involvement. Automate processes. Delegate tasks. Improve efficiency. Over time, reduce your hands-on role while maintaining performance. This transition from operator to overseer is essential. Confidence grows with each milestone. The first recurring payment. The first reinvestment. The first month when income arrives without direct effort. These moments are quiet, but powerful. They reinforce belief. They build discipline. They confirm that the asset game is not abstract theory. It is practical reality. Remember, the size of the first engine matters less than its stability. A small, reliable system is more valuable than a large, unstable one. Stability builds trust in your process. Trust allows you to scale without fear. Building your first income engine is an act of commitment. It signals that you are no longer content to rely solely on earned income. It marks your entry into ownership. It transforms your role from participant to creator. Once the first engine is running, the path becomes clearer. You refine, replicate, and expand. Momentum compounds, and what began as a modest structure becomes the cornerstone of lasting financial freedom. Chapter 6. Stack assets like building blocks. One asset is progress. Multiple assets are power. The asset game is not won with a single move. It is won by stacking intelligent moves over time. Each asset you build becomes a building block. When placed carefully, those blocks form a structure that grows stronger with every layer. Think of it this way. Your first income engine proves the concept. Your second strengthens it. Your third accelerates it. Stacking assets is about intentional layering. Instead of relying on one stream of income, you create several. Instead of hoping one opportunity will carry you forever, you design a portfolio of engines that support each other. Stacking requires patience and discipline. The temptation is to expand too quickly. After experiencing initial success, it is easy to chase every new opportunity. But intelligent stacking is strategic, not scattered. Each new asset should complement the ones you already own. It should either increase cash flow, reduce risk, or expand your capacity to grow. There are two primary ways to stack: horizontally and vertically. Horizontal stacking means adding different income sources across various areas. For example, combining business ownership with dividend-producing investments or rental properties. This spreads risk and increases stability. If one asset slows down, others continue producing. Vertical stacking focuses on strengthening a single system. You reinvest profits to expand capacity. A business grows into multiple locations. A small portfolio expands into a larger one. A digital product line evolves into a full platform. Vertical stacking deepens your position. Horizontal stacking broadens it. Both have value when applied intentionally. The power of stacking lies in compounding. Each asset produces income. That income funds the next asset. Over time, the cycle accelerates. What once required intense effort begins to generate momentum on its own. You move from pushing every block manually to watching the structure rise steadily. Risk management improves through stacking as well. Dependence on a single asset creates vulnerability. Market changes, unexpected events, or operational challenges can disrupt income. Multiple assets create resilience. They act as shock absorbers. Stability increases not because risk disappears, but because exposure is distributed. Stacking also changes your mindset. You begin thinking in terms of systems rather than transactions. Instead of focusing on one successful deal, you focus on repeatable models. Repeatability is powerful. When you understand how an asset works, you can replicate the process. Replication builds consistency. Consistency builds scale. However, stacking must be paced carefully. Growth without discipline leads to strain. Each asset requires oversight, even if minimal. Before adding another block, ensure the previous one is stable. Stability creates confidence. Confidence allows for expansion without chaos. As assets accumulate, something important happens. Optionality increases. When income flows from multiple sources, decisions are less pressured. You negotiate better. You choose opportunities more carefully. You are not desperate for immediate returns because your foundation is stronger. That freedom improves judgment. Another benefit of stacking is psychological security. Watching multiple streams operate simultaneously reinforces belief in the process. You see proof that wealth building is systematic. This reduces emotional reactions to temporary setbacks. If one asset underperforms, others compensate. Perspective replaces panic. Over time, stacking transitions from effort to architecture. You are no longer focused on isolated gains. You are building an interconnected system. Profits circulate. Investments reinforce each other. Cash flow funds growth. Growth increases cash flow. The cycle strengthens itself. It is important to remember that stacking is gradual. The early years may show modest expansion, but steady accumulation outperforms dramatic bursts. Quiet progress compounds more reliably than aggressive leaps. The asset game rewards durability. Each block you place represents foresight. Each asset you add increases leverage. With enough layers, your structure becomes self-supporting. Income continues regardless of daily effort. Decisions become strategic rather than reactive. Stacking assets like building blocks is not about speed, it is about design. A well-designed structure withstands pressure. It grows predictably. It supports future expansion. Begin with one stable block, add another with care. Reinforce the foundation. Continue patiently. In time, what started as a single engine becomes a framework of wealth, solid, layered, and resilient. And that structure is what ultimately frees you. Chapter 7. Use leverage as a multiplier, not a crutch. Leverage is one of the most powerful forces in the asset game. Used wisely, it accelerates growth. Used carelessly, it magnifies mistakes. The difference lies not in the tool itself, but in the discipline of the person holding it. At its core, leverage means using resources beyond your own to increase results. It can be financial leverage, such as borrowed capital. It can be human leverage, such as hiring skilled people. It can be technological leverage, such as automation and digital systems. It can even be intellectual leverage, where your ideas are distributed at scale. The wealthy understand that personal effort alone has limits. Leverage extends those limits. Financial leverage is the most discussed and the most misunderstood. Borrowing money to acquire income-producing assets can amplify returns. If an asset generates more income than the cost of borrowing, the difference becomes profit. This is how many large portfolios are built. But leverage must be tied to productive assets, not consumption. Borrowing for liabilities weakens your position. Borrowing for carefully evaluated, cash-flowing assets can strengthen it. The key word is carefully. Leverage multiplies outcomes. If your foundation is weak, leverage magnifies weakness. If your cash flow is unstable, debt increases stress. If your analysis is flawed, borrowed money accelerates losses. This is why discipline must come before expansion. Stability first. Acceleration second. Human leverage is equally powerful. Delegation transforms time. When you hire competent people and build clear systems, productivity expands beyond your personal capacity. One person can only do so much. A coordinated team can do far more. Leadership becomes a form of leverage. By aligning incentives and providing structure, you multiply impact. Technology offers another dimension. Automation reduces repetitive tasks. Digital platforms distribute products globally. Software scales processes without increasing labor proportionally. A single idea can reach thousands, even millions, when paired with the right systems. This is modern leverage, efficiency embedded into infrastructure. However, leverage must never become a crutch. A crutch supports weakness. A multiplier strengthens strength. If you rely on leverage to compensate for poor planning, lack of knowledge, or emotional decision-making, it will expose you. The wealthy prepare thoroughly before expanding. They understand numbers, they measure risk, they create buffers. They do not depend on optimism. One of the greatest mistakes in the asset game is overextension. Success in one venture often creates confidence. Confidence can quietly become overconfidence. Expansion becomes aggressive. Debt increases rapidly. Complexity multiplies. Without careful oversight, the structure becomes fragile. Discipline must grow alongside ambition. A useful principle is this: leverage should increase capacity without threatening stability. If removing leverage would collapse your structure, you are overexposed. Healthy leverage enhances performance, but does not define survival. You remain resilient even if conditions shift. Another important factor is timing. Early in your journey, focus more on building competence and stable cash flow. As your understanding deepens and your assets strengthen, leverage becomes safer. Growth built gradually is sustainable. Rapid growth built on weak foundations is dangerous. Leverage also requires emotional control. Market cycles fluctuate. Economic conditions shift. Interest rates change. The disciplined builder anticipates variability. They prepare contingency plans. They maintain liquidity. They avoid making decisions under panic or euphoria. When used wisely, leverage compresses time. It allows you to accomplish in 5 years what might otherwise take 15. It accelerates stacking. It amplifies compounding, but it must be respected. Respect prevents recklessness. Think of leverage as a powerful engine booster. Without direction, it causes loss of control. With direction and discipline, it increases speed toward your destination. The objective is not maximum leverage. The objective is optimal leverage. The amount that supports growth while preserving security. The asset game rewards those who expand intelligently. Learn to measure risk. Strengthen your analysis. Build reserves. Then apply leverage strategically. Let it multiply strong foundations rather than mask weak ones. When you treat leverage as a multiplier, instead of a crutch, it becomes one of your greatest allies. It extends your reach. It accelerates your progress. And when aligned with discipline, it transforms steady growth into exponential momentum. Chapter 8. Design assets that outlive your effort. The true test of an asset is simple. Does it continue to produce when you step away? If your income disappears the moment you stop working, you have built activity, not an asset. The asset game is won by designing structures that outlive your daily effort. In the beginning, almost every asset requires involvement. You plan it, you build it, you manage it. That is natural, but from the start, your vision must extend beyond your presence. The goal is gradual independence. You design with the end in mind, an engine that operates through systems, not constant supervision. Recurring revenue is the foundation of durable assets. One-time transactions create spikes of income. Recurring models create stability. Subscriptions, long-term contracts, rental agreements, dividend-producing investments, royalties. These structures generate predictable flow. Predictability reduces stress. It allows planning. It strengthens decision-making. The difference between a job and a scalable asset is repeatability. If the value you provide can be delivered repeatedly without reinventing the process each time, you are building something durable. Systems turn effort into structure. Documentation turns knowledge into transferable processes. Automation reduces dependency on memory and manual oversight. Delegation plays a critical role. Many builders struggle here. They fear losing control. They believe no one else can execute as well as they can. In the early stages, that may feel true, but growth demands trust and training, clear expectations, measurable standards, accountability. When responsibilities are defined properly, performance becomes consistent without constant involvement. Technology amplifies durability. Payment systems, management software, marketing automation, digital distribution platforms. These tools embed consistency into your operations. They reduce friction. They allow scale without proportional increase in labor. Once configured correctly, they work continuously. Another essential principle is simplicity. Complexity increases fragility. The more moving parts your asset has, the more oversight it requires. Streamlined models are easier to maintain. Clear revenue structures outperform complicated arrangements. The wealthy favor clarity because clarity scales. Designing assets that outlive your effort also means separating yourself from daily operations. Transition from operator to overseer. Monitor performance through reports and metrics rather than constant physical presence. Numbers tell stories. Cash flow statements, profit margins, growth rates. These indicators guide adjustments without requiring immersion in every detail. Patience is necessary. Independence does not happen immediately. At first, you may be deeply involved. Gradually, as processes stabilize, your role shifts. You refine, you optimize, you remove bottlenecks. Each improvement reduces reliance on you personally. Over time, the system becomes self-sustaining. Ownership structure matters here as well. Clear agreements with partners, defined responsibilities, and protected equity ensure continuity. Without structure, assets dissolve when challenges arise. With structure, they endure. Liquidity is another aspect of durability. An asset that generates cash flow but traps all value inside itself limits flexibility. Balanced design allows both income and reinvestment. It provides returns while preserving growth potential. Think long-term. Ask yourself, if I stepped away for 3 months, would this asset continue producing? If the answer is no, refine the design. Improve automation. Strengthen delegation. Clarify systems. Each adjustment increases resilience. Durable assets create time freedom. They detach income from physical presence. That detachment changes your life. Decisions are no longer rushed. Opportunities are evaluated calmly. Creativity expands because survival pressure decreases. The ultimate objective is autonomy. Assets that operate independently provide options. You may choose to remain involved strategically, but you are not required to be present for income to flow. That distinction is powerful. Design deliberately. Build systems from the beginning. Reinforce structure consistently. Replace manual processes with repeatable frameworks. Train people. Implement technology. Measure performance. When your assets outlive your effort, you step into a new level of the asset game. Income becomes structural. Time becomes flexible. Growth becomes sustainable. And freedom shifts from theory to reality. Chapter 9. Turn volatility into advantage. Markets move. Economies expand and contract. Prices rise, then fall. Optimism spreads, then fear replaces it. Volatility is not an exception in the asset game, it is part of the design. Those who understand this do not panic when conditions shift. They prepare, they observe, and when the moment is right, they act. Uncertainty creates opportunity. When fear dominates, assets are often undervalued. When excitement dominates, assets are often overpriced. The disciplined builder learns to recognize emotional extremes. Instead of following the crowd, they study behavior. They understand that markets are influenced not only by numbers but by psychology. During periods of expansion, confidence rises, credit becomes accessible, optimism spreads quickly. It feels like growth will continue forever. This is when caution becomes important. Overpaying for assets during euphoric cycles reduces long-term returns. Discipline means evaluating fundamentals even when enthusiasm is high. Ask yourself, does this asset generate consistent cash flow? Is the price justified by performance? Would it still make sense if growth slowed? When contraction arrives, fear dominates. News becomes negative. Investors hesitate. Opportunities appear risky. This is when courage, backed by analysis, becomes valuable. Assets that remain fundamentally strong may become available at discounted valuations. The disciplined builder does not rush blindly, but neither do they freeze. They assess liquidity. They measure risk. They position themselves carefully. Liquidity is power during volatility. Cash reserves provide flexibility. Without liquidity, even the best opportunities cannot be seized. This is why building buffers is essential. Reserves are not idle money. They are strategic ammunition. They allow you to act when others cannot. Emotional control becomes a competitive advantage. Panic selling destroys value. Impulsive buying during hype inflates risk. The wealthy train themselves to respond slowly and deliberately. They rely on data, not headlines. They revisit their strategy rather than reacting to noise. Diversification also plays a role. Multiple asset classes behave differently under stress. When one sector weakens, another may remain stable. Spreading exposure reduces the impact of localized downturns. Stability allows patience. Patience allows intelligent action. Volatility also strengthens long-term perspective. Short-term fluctuations feel dramatic, but over decades, disciplined strategies outperform emotional reactions. Compounding works best when uninterrupted. Selling strong assets prematurely interrupts growth. Staying invested in quality assets through cycles often yields better outcomes than attempting to predict every shift. Another advantage of volatility is learning. Market corrections reveal weaknesses. Over-leveraged positions become exposed. Poor risk management surfaces. These lessons refine judgment. Each cycle improves discipline for the next. Opportunity often appears disguised as discomfort. Investing during uncertainty feels uncomfortable. Expanding cautiously when others retreat feels risky. Yet history repeatedly shows that disciplined action during downturns builds future strength. The key is preparation before volatility arrives. Study markets during stable periods. Build reserves. Strengthen cash flow. When conditions change, you will not be reacting. You will be executing a plan. It is important to distinguish between temporary volatility and structural decline. Analysis matters. Not every falling asset is a bargain. Fundamentals must remain sound. Cash flow must remain viable. Discipline requires discernment. Volatility also encourages humility. Markets cannot be controlled. Predictions are imperfect. Accepting uncertainty keeps arrogance in check. Balanced confidence, grounded in preparation, replaces reckless certainty. The asset game rewards resilience. Resilience is built through preparation, patience, and perspective. When volatility arrives, it tests emotional strength more than technical knowledge. Those who remain calm preserve capital. Those who analyze carefully identify value. Those who act strategically convert uncertainty into advantage. View volatility not as an enemy, but as a cycle. It is the rhythm of markets. It clears excess. It resets valuations. It offers entry points. With discipline and preparation, you can transform what others fear into fuel for growth. In the long run, consistency outperforms reaction. Preparation outperforms prediction, and calm, strategic action during uncertain times becomes one of the most powerful advantages in the asset game. Chapter 10. Protect the castle. Building wealth is one skill. Keeping it is another. Many people learn how to generate income, how to invest, how to scale, but far fewer learn how to protect what they build. In the asset game, protection is not fear, it is strategy. A castle without walls may look impressive, but it remains vulnerable. Protection begins with awareness. Every asset carries risk. Businesses face competition. Properties face market fluctuations. Investments face volatility. Ignoring risk does not eliminate it. A disciplined builder identifies potential threats early. What could weaken this asset? What could disrupt cash flow? What could expose liability? Asking these questions does not create negativity. It creates preparation. Diversification is one of the first defensive walls. Concentrating everything in a single asset may produce strong returns during favorable conditions, but it increases exposure. If that one asset struggles, the impact is severe. Spreading investments across different sectors, structures, or markets reduces vulnerability. Diversification does not eliminate risk entirely, but it distributes it intelligently. Legal structure is another critical defense. Ownership matters, but how you own matters even more. Proper contracts, clear partnership agreements, defined roles, limited liability structures. These elements protect personal assets from business risks and clarify responsibilities. Vague arrangements invite conflict. Precise documentation preserves stability. Liquidity is also protection. An asset may be valuable on paper, yet difficult to convert into cash quickly. Without liquidity, unexpected expenses create stress. Maintaining accessible reserves allows you to handle disruptions calmly. Liquidity provides flexibility. It allows you to navigate downturns without selling long-term assets prematurely. Insurance plays a role as well. Property insurance, liability coverage, business interruption policies. These are not signs of weakness. They are tools of prudence. The goal is not to expect disaster, but to ensure that if disruption occurs, recovery is possible. Protection is about continuity. Debt management forms another defensive layer. Leverage, when used wisely, accelerates growth, but unmanaged debt increases fragility. Regularly review obligations. Ensure that cash flow comfortably covers commitments. Avoid stacking excessive leverage during favorable periods. Strong defense requires margin. Margin absorbs shocks. Tax planning is part of preservation. Efficient structures reduce unnecessary outflow. Understanding applicable laws allows you to retain more of what you earn. Preservation is not about avoiding responsibility. It is about managing it intelligently. Structured planning prevents surprises. Another essential aspect of protecting the castle is vigilance. Periodic review of assets ensures they remain aligned with your goals. Markets evolve. Regulations change. Businesses mature. Regular evaluation keeps your strategy current. Protection is ongoing, not a one-time task. Reputation is an often overlooked defense. Integrity in transactions builds trust. Trust strengthens partnerships. Strong relationships provide support during challenges. Ethical conduct protects long-term positioning. Emotional discipline contributes to defense as well. Panic selling during downturns erodes value. Impulsive expansion during growth cycles increases exposure. Balanced decisions maintain stability. Patience protects capital. As your asset base grows, complexity increases. Complexity requires oversight. Delegation must include accountability. Reporting systems should provide clarity. Transparency within your organization prevents internal weaknesses. A well-informed leader detects problems early. Protection also means knowing when to exit. Holding every asset indefinitely is not always wise. Sometimes preserving wealth means selling strategically. Evaluate performance objectively. If an asset no longer aligns with long-term strategy, adjust accordingly. The castle you build represents years of effort, discipline, and calculated risk. Guarding it does not mean living cautiously or fearfully. It means respecting what you have created. It means ensuring that growth is supported by structure. In the asset game, growth and protection must advance together. Expansion without defense leads to fragility. Defense without growth leads to stagnation. Balance creates durability. When your walls are strong, you think clearly, you invest confidently, you expand strategically. Protection transforms wealth from temporary success into lasting stability. And lasting stability is what allows freedom to endure. Chapter 11. Increase your asset IQ. Wealth does not respond to emotion. It responds to understanding. The more you understand how assets function, the more confidently you move in the asset game. Increasing your asset IQ is not about memorizing complex financial jargon. It is about learning how money behaves, how deals are structured, and how value is measured. Every asset tells a story through numbers. Revenue reveals demand. Expenses reveal efficiency. Cash flow reveals stability. Growth rates reveal momentum. When you learn to read these indicators, you stop guessing. You start evaluating. Decisions shift from hope to calculation. Start with the basics. Understand the difference between revenue and profit. A business can generate impressive sales yet struggle because expenses consume margins. Learn to examine net income, not just gross figures. Profitability matters more than appearance. Cash flow deserves special attention. Profit on paper does not guarantee liquidity. An asset may show earnings while cash remains tied up. Positive cash flow, consistently generated, strengthens stability. It funds reinvestment. It supports expansion. It reduces reliance on external financing. Return on investment is another essential concept. Every dollar deployed should be evaluated against its potential return. Compare opportunities objectively. If one investment produces higher returns with similar risk, it deserves attention. Measuring performance prevents emotional attachment from clouding judgment. Risk assessment also sharpens your asset IQ. Evaluate downside scenarios. What happens if revenue drops by 20%? What if expenses increase unexpectedly? Planning for stress conditions reveals resilience. Strong assets withstand pressure without collapsing. Debt ratios, operating margins and valuation metrics may initially seem technical. With practice they become familiar tools. They allow you to see beyond marketing presentations and enthusiastic projections. Numbers rarely exaggerate. They reveal reality. Education must be ongoing. Markets evolve. Industries change. Regulations shift. Continuous learning keeps you adaptive. Read financial statements. Study case examples. Observe market trends. Exposure builds pattern recognition. Over time you begin noticing strengths and weaknesses quickly. Mentorship accelerates growth. Learning from experienced investors shortens the curve. Conversations with knowledgeable peers refine your thinking. Surround yourself with individuals who challenge assumptions. Insight multiplies through shared experience. Another aspect of asset IQ is recognizing value beyond surface impressions. Some opportunities appear ordinary but hold strong fundamentals. Others appear glamorous but lack substance. Discernment develops through study and observation. Resist the temptation to chase excitement. Focus on sustainability. Asset IQ also includes negotiation skills. Understanding how value is created allows you to negotiate terms confidently. When you comprehend margins and risk, you can structure agreements intelligently. Knowledge strengthens leverage. Technology enhances analysis. Financial software, market data platforms and reporting tools provide clarity. Use them wisely. Data supports better decisions when interpreted correctly. Emotional intelligence complements financial knowledge. Recognize how fear and greed influence markets. Monitor your reactions. Calm analysis outperforms impulsive behavior. Asset IQ grows when discipline guides action. Learning does not require formal degrees. Curiosity drives progress. Ask questions, seek clarity, study failures as carefully as successes. Mistakes teach lessons that theory cannot. Confidence emerges from competence. When you understand metrics, risk, and structure, uncertainty becomes manageable. You approach opportunities strategically rather than hesitantly. You decline weak proposals confidently. You pursue strong ones decisively. Increasing your asset IQ transforms your role in the game. You no longer depend solely on advice. You evaluate independently. You participate actively. You build with intention. Wealth rewards preparation. Preparation begins with knowledge. Knowledge strengthens judgment. Judgment shapes decisions, and decisions, repeated consistently, determine outcome. Commit to learning continuously. Refine your understanding. Sharpen your analysis. The higher your asset IQ, the stronger your position in every negotiation, every investment, and every strategic move. In the asset game, understanding is power. Chapter 12. Scale with discipline. Growth is exciting. Expansion feels powerful. When your assets begin producing consistently, the natural desire is to accelerate, add more, expand faster, multiply quickly, and growth is necessary, but only when guided by discipline. In the asset game, scaling without structure creates instability. Scaling with discipline creates strength. The first principle of scaling is readiness. Not every successful asset is prepared for expansion. Stability must come first. Consistent cash flow, reliable systems, clear reporting, predictable performance. If the foundation is unstable, scaling amplifies weakness. If the foundation is strong, scaling multiplies strength. Scaling requires systems, not heroics. If your asset depends heavily on your personal effort, expansion increases pressure rather than freedom. Before growing, examine operations. Are processes documented? Are responsibilities clearly defined? Can performance be measured consistently? Systems transform growth from chaos into structure. Capital management becomes more important during scaling. Expansion often requires investment, new equipment, additional staff, marketing, infrastructure. Each dollar must be allocated carefully. Overexpansion drains liquidity. Maintain reserves even while growing. Strong offense still requires defense. Another important element is delegation. As assets expand, complexity increases. You cannot manage every detail personally. Hiring capable individuals becomes essential, but hiring alone is not enough. Leadership, clarity, and accountability ensure performance remains consistent. Growth multiplies responsibility. Scaling also tests decision-making. Opportunities appear rapidly during expansion phases. Partnerships, acquisitions, new markets. Evaluate each carefully. Not every opportunity aligns with long-term strategy. Discipline means declining attractive distractions. Focus creates momentum. Scattered expansion weakens it. Metrics guide disciplined growth. Track revenue growth rates. Monitor expense ratios. Measure profit margins. Analyze customer retention or tenant stability. Data reveals whether scaling strengthens or strains the asset. Numbers replace guesswork. Market conditions influence scaling decisions as well. Expanding aggressively during unstable periods may increase exposure. Expanding cautiously during favorable conditions may limit potential. Timing requires balance. Study the environment, but rely on fundamentals. Culture also matters when scaling businesses. Values established early must remain intact. Growth can dilute standards if leadership is inattentive. Protecting culture preserves quality and reputation. Reputation sustains long-term expansion. Leverage may play a role during scaling. Borrowed capital can accelerate growth, but only when cash flow comfortably supports repayment. Avoid stacking excessive leverage during expansion. Growth funded by unsustainable debt creates fragility. Sustainable scaling balances ambition with prudence. Patience remains essential. Rapid expansion feels impressive, but steady growth often proves more durable. Consistency compounds. Disciplined scaling outperforms aggressive bursts followed by contraction. Another principle is refinement before replication. Perfect the model before multiplying it. Test processes thoroughly. Ensure customer satisfaction. Optimize margins. When the model works predictably, replication becomes efficient. Scaling also requires mental discipline. Success can inflate confidence. Confidence can lead to complacency. Stay vigilant. Review performance regularly. Question assumptions. Continuous improvement prevents stagnation. Remember that scaling is not an end in itself. Growth must align with purpose. Expanding simply to increase size may dilute focus. Expanding strategically increases value and freedom. Evaluate whether growth enhances cash flow, stability, and long-term positioning. As your assets grow, leadership becomes your primary responsibility. Clear vision, measured decisions, structured oversight. Growth guided by discipline produces sustainable momentum. Scaling with discipline transforms a successful asset into a lasting enterprise. It increases impact without sacrificing stability. It builds influence without increasing fragility. In the asset game, expansion is powerful when anchored in structure. Grow deliberately, expand intelligently, strengthen foundations continuously. When discipline leads growth, scale becomes an ally rather than a threat. Chapter 13. Build a circle of builders. No one wins the asset game alone. Independence is the goal, but isolation is not the method. Every strong portfolio, every thriving enterprise, every enduring structure is supported by relationships. Behind visible success stands a circle of builders, advisors, partners, mentors, peers, individuals who understand the game and sharpen each other's thinking. Environment shapes standards. If you surround yourself with people who think only about spending, you will feel pressure to consume. If you surround yourself with people who think about ownership, you will feel inspired to build. Conversations influence decisions. Exposure shapes ambition. The circle you choose quietly influences the ceiling you accept. A circle of builders does not mean a large network. It means a deliberate one. Quality over quantity. Seek individuals who value discipline, long-term thinking, and ethical growth. People who ask thoughtful questions. People who challenge assumptions respectfully. People who focus on structure rather than spectacle. Mentorship accelerates understanding. Someone who has navigated market cycles, negotiated deals, faced setbacks, and preserved wealth, carries perspective. You cannot gain from theory alone. Listening carefully to experience reduces avoidable mistakes. A mentor does not eliminate risk, but they illuminate blind spots. Partnership also multiplies capability. One person may excel in strategy, another may excel in operations, another may understand finance deeply. Combined strengths create leverage. The key is alignment, shared values, clear expectations, defined roles. Partnerships without clarity create conflict. Partnerships with structure create expansion. Trust forms the foundation of any builder's circle. Trust is earned through consistency and integrity. Deliver on commitments. Communicate transparently. Protect confidentiality. Reliability strengthens relationships over time. Intellectual exchange sharpens asset IQ. Discussing opportunities with thoughtful peers reveals angles you may overlook. Diverse perspectives enhance evaluation. Healthy debate refines judgment. Avoid echo chambers, where every idea receives immediate approval. Seek constructive challenge. Accountability is another powerful benefit of a builder's circle. When goals are shared, progress becomes measurable. Disciplined peers encourage consistency. Knowing others are advancing motivates effort. Collective growth creates momentum. The wealthy often participate in structured groups, advisory boards, investment circles, strategic alliances. These environments provide access to information, capital, and insight. Being in the room where serious conversations happen changes perspective. Exposure expands thinking. Generosity also strengthens your circle. Share knowledge. Offer assistance. Provide introductions when appropriate. Value exchange builds mutual respect. Strong networks are reciprocal, not transactional. Choose associates carefully. Negative influences drain focus. Short-term thinkers create unnecessary risk. Integrity matters more than charisma. Reputation compounds over time, positively or negatively. As your assets grow, your circle should evolve. Early mentors may guide foundational understanding. Later advisors may specialize in scaling, legal structure, or tax optimization. Continuous growth requires continuous refinement of your environment. Avoid comparing journeys within your circle. Each builder operates at a different stage. Comparison breeds insecurity. Focus instead on learning and contributing. Mutual advancement strengthens relationships. Silence has value as well. Not every idea requires broad discussion. Share selectively with trusted individuals. Protect strategic thinking until execution is secure. Building a circle of builders reinforces long-term thinking. It normalizes discipline. It reduces emotional decisions. It strengthens resilience during volatility. The asset game rewards collaboration guided by clarity. Independence of income does not eliminate interdependence of insight. Strength grows when perspectives combine. Choose your circle intentionally. Cultivate trust. Encourage accountability. Learn continuously. Contribute generously. When you build alongside other disciplined thinkers, your growth accelerates. Your judgment sharpens. Your opportunities expand. And your structure becomes stronger because it rests not only on assets, but on aligned relationships. In this game, wisdom shared multiplies. Chapter 14. Play the long game relentlessly. Wealth, built quickly, can disappear quickly. Wealth built patiently tends to endure. The asset game is not a sprint measured in months. It is a long strategic campaign measured in years, even decades. Those who understand this move differently. They think differently. They decide differently. Short-term thinking is seductive. Immediate profits feel rewarding. Quick wins generate excitement. But short-term focus often sacrifices durability. The wealthy prioritize sustainability over speed. They are willing to accept slower growth if it builds stronger foundations. Compounding thrives in time. An asset that grows steadily for 20 years outperforms a dramatic surge followed by decline. Patience multiplies returns. Reinvestment strengthens assets. Consistency compounds momentum. Playing the long game requires emotional resilience. Markets fluctuate. Opportunities fail. Setbacks occur. Without long-term perspective, temporary challenges feel permanent. With long-term perspective, they become part of the process. Resilience replaces panic. Delayed gratification becomes a powerful advantage. Choosing to reinvest profits instead of spending them accelerates future growth. Sacrificing short-term luxury for long-term freedom shifts outcomes dramatically. The disciplined builder understands that every dollar deployed strategically today multiplies tomorrow. Long-term thinking also sharpens decision-making. Before entering any deal, ask, will this still make sense in 10 years? Does it align with enduring value? Trends fade, fads lose momentum. Durable assets serve real needs consistently. Focus on fundamentals rather than hype. Reputation compounds alongside capital. Integrity maintained over decades builds trust. Trust opens doors. Consistent behavior strengthens positioning. In the long game, credibility becomes an asset. Another principle of the long game is endurance. Many competitors exit prematurely. They lose patience. They chase distractions. They abandon strategy after temporary setbacks. Simply staying disciplined while others retreat increases your advantage. Strategic reinvestment plays a central role. Profits reinvested generate exponential growth over time. Removing capital too early interrupts compounding. Patience allows exponential curves to develop. Risk management aligns with long-term thinking. Avoid catastrophic losses. Protect principal. Preserve the ability to continue playing. Survival is success in volatile periods. Those who remain in the game benefit when cycles recover. Time also refines skill. Experience accumulates. Judgment improves. Each cycle strengthens understanding. Long-term participation deepens asset IQ. The long game does not eliminate ambition, it channels it. Growth remains important. Expansion continues. But urgency is replaced with intentionality. Decisions align with enduring objectives. Consistency becomes your greatest ally. Regular investments, steady improvements, measured scaling, incremental stacking. Small disciplined actions repeated over years outperform sporadic bursts of intensity. Perspective matters. A single setback does not define a decade. A temporary downturn does not erase structural strength. Viewing progress across long horizons reduces emotional volatility. Playing relentlessly does not mean recklessly. It means staying committed. It means maintaining focus despite distractions. It means refining strategy without abandoning it. Vision anchors long-term effort. Define what financial independence looks like for you. Clarify the level of income, stability, and freedom you seek. Clear vision sustains discipline through difficult phases. The asset game rewards those who endure intelligently. Over decades, disciplined builders accumulate assets, refine systems, strengthen networks, and protect capital. Momentum builds gradually, then visibly. Patience outlasts speculation. Discipline outperforms excitement. Structure defeats impulse. Commit to the long horizon. Make decisions that strengthen your position year after year. Reinforce foundations. Improve systems. Protect assets. Reinvest consistently. When you play the long game relentlessly, wealth becomes less about luck and more about inevitability. Time, properly harnessed, becomes your most powerful ally. And in the asset game, those who endure with discipline ultimately dominate. Chapter 15. Graduate from earner to architect. At the beginning of this journey, income depended on effort. Hours created earnings. Energy sustained lifestyle. Security felt tied to presence. Now, after learning the rules, building engines, stacking assets, using leverage wisely, protecting structure, and playing the long game, a shift becomes possible. You are no longer simply earning, you are designing. Graduating from earner to architect is not about stopping work. It is about redefining your role. An earner trades time for compensation. An architect designs systems that produce regardless of time. The difference is structural. One depends on activity. The other depends on ownership. As an architect, you think in blueprints. You examine how income flows. You identify where value is created. You optimize processes. You position assets strategically. You do not ask, how hard must I work? You ask, how well is this system built? This shift changes decisions. You no longer chase every opportunity for immediate income. You evaluate whether it strengthens your structure. You measure long-term impact rather than short-term reward. Patience becomes natural because you understand design takes time. Architects focus on alignment. Assets must support personal goals. Financial freedom is not only about numbers, it is about flexibility. The ability to choose how to spend time. The ability to say no without fear. The ability to pursue purpose without financial pressure. Systems exist to serve life, not dominate it. At this stage, clarity matters deeply. Define what freedom means to you. Is it location independence? Is it the ability to invest in passion projects? Is it security for family? Design requires intention. Without clarity, expansion can become endless pursuit rather than meaningful progress. Delegation strengthens architecture. Trusting capable individuals to manage components of your system ensures sustainability. Oversight replaces micromanagement. Vision replaces daily execution. You focus on strategic refinement rather than operational detail. Wealth at this level is quiet. It does not require display. Confidence comes from structure. Income flows without constant attention. Decisions are measured, not reactive. Growth is strategic, not frantic. Responsibility increases as well. Architecture influences others. Employees, partners, tenants, investors. They rely on the integrity of your systems. Ethical leadership preserves long-term stability. Integrity remains foundational. Another element of graduation is detachment from fear. When income becomes structural, fear of temporary disruption decreases. Volatility becomes manageable. You are insulated by diversified assets and disciplined design. Confidence replaces anxiety. Continuous refinement remains important. Architects review blueprints regularly. They improve efficiency. They adapt to changing conditions. Complacency weakens structure. Ongoing evaluation strengthens it. Legacy becomes relevant at this stage. Assets can outlive you. Systems can benefit future generations. Thoughtful planning ensures continuity. Estate structures, succession planning, clear documentation. These preserve impact. But remember, graduation is not a final destination. It is a new level of responsibility and opportunity. Growth continues. Learning continues. Refinement continues. The difference is that effort is now strategic rather than survival-driven. Reflect on the transformation. You began focused on earning. You learned the rules. You built engines. You stacked assets. You leveraged intelligently. You protected what you built. You scaled with discipline. You played the long game. Now you design. Architects shape outcomes intentionally. They do not drift. They plan. They evaluate. They adjust. They build with purpose. The asset game ultimately rewards those who move beyond earning into ownership, beyond ownership into design. When income works without constant effort, time becomes flexible. When systems operate independently, decisions become empowered. Graduate fully. Embrace the responsibility. Continue refining your structure. Let your assets serve your vision. And remember, true architecture is not measured only by wealth accumulated, but by freedom created and stability sustained. In the asset game, becoming an architect is the ultimate elevation, the point where income supports life, and life is directed by choice rather than necessity. Conclusion. Win the game quietly. The asset game was never about money alone. It was about control. Control over time. Control over decisions. Control over the direction of your life. Money is simply the tool. Assets are the structure. Discipline is the strategy. You began this journey understanding that earning is not the same as owning. You saw how the income trap keeps capable people busy but dependent. You learned that before making a move, you must understand the rules. You shifted from buying status to buying cash flow. You positioned yourself on the right side of the deal. You built your first income engine. You stacked assets deliberately. You used leverage wisely. You designed systems that outlived your effort. You turned volatility into opportunity. You protected what you built. You increased your asset IQ. You scaled with discipline. You surrounded yourself with builders. You played the long game relentlessly. And finally, you graduated from earner to architect. This transformation is not theoretical. It is practical. It is structural. It is available to anyone willing to think differently and act consistently. The world often celebrates visible success, the car, the house, the public recognition, but real wealth is quiet. It does not need applause. It does not require validation. It exists in the background, producing, compounding, strengthening. It shows itself in freedom of schedule, calm decision-making, and resilience during uncertainty. Winning the asset game is not about competing with others. It is about mastering your own structure. It is about moving from reaction to intention, from dependence to design, from income tied to effort to income supported by assets. There will be challenges ahead, markets will shift, opportunities will appear and disappear, doubt may visit, but structure endures, discipline endures, knowledge endures. Each asset you build strengthens your position, each wise decision compounds your advantage. Remember this, small moves repeated consistently create extraordinary results over time. A single asset may feel insignificant, a disciplined habit may seem minor, but compounding transforms modest beginnings into powerful outcomes. Patience is not weakness, it is strategic strength. Protect your structure, continue learning, refine your systems, stay disciplined during growth, and calm during volatility. Expand thoughtfully, preserve wisely, lead ethically. Freedom is not granted, it is built, brick by brick, asset by asset, decision by decision. You now understand the game, you know the rules, you have the blueprint. The next step is action, deliberate, consistent, intelligent action. Play the game quietly, build steadily. Let your assets speak through stability, not noise, and over time you will find that income works for you, time bends in your favor, and life becomes something you design rather than something you endure. That is the power of the asset game.